In today's video, we're going to be going over 5 rules to incorporate when it comes to picking your individual stock. Now, when I first got started investing, that's all I was investing into stocks, crypto. But in time, I incorporated ETFs, which I do about 60% of when it comes to building my portfolios, and an even higher percentage of funds when it comes to my retirement accounts. But I also incorporate those individual stocks in order to strive for additional growth when it comes to my portfolio. Today, we're going to go over 5 rules that you can incorporate in choosing your individual stocks that will allow you to hold them confidently and create a portfolio that will allow you to sleep well at night, even when the markets are crazy. I am Lisa J. Stocks. If you're not already, subscribe, like this video, and hit that notification bell so you can keep up with all of my videos and live streams. First, let me break down the 5 rules we're going to go over. Number 1, do your homework. Have an understanding of what you own. 2, does this company have a competitive advantage? 3, is it a sleep well at night stock? Relatively safe and having steady growth? 4, can you hold it for the long term and let compounding do its magic? And 5, know when to sell when the company's growth and fundamentals are no longer in line with your goals. You are the boss of your portfolio. Rule 1, do your homework. Before investing, answer this question: how does this company make money? Where is their revenue coming from? That's the total money that the company brings in from sales. And for this one, we're going to use Google as our example. This is where Google's revenue comes from: 56% from search ads, 12% from YouTube ads, 11% from Google Cloud, and the remaining from other sources like Pixel, an Android device. So we know what this company does. Basically, Google makes money when you click on ads. Now, rule number 2, does the company have a competitive advantage? And for this one, we're going to use Meta as our example. We're asking ourselves, does this company have something unique? Something that is hard to copy, a certain edge that allows it to outperform its rivals as well as protect its profits. And when it comes to Meta, they have a family of apps: Facebook, Instagram, WhatsApp, Threads, with 3.9 billion active users on a monthly basis. Your friends are there. Every company, restaurant, clothing brand that you can think of is there. It gets to know you. It understands your preferences and shows you ads that actually convert into what you are interested in. So Meta is definitely a leader in this area, compared to rivals like TikTok that has about 1.6 billion users. So, in thinking about incorporating these individual stocks into your portfolio, you have to keep in mind, are you going to be able to hold this for the long term? Does the edge that the company has long lasting for the next 5 to 10 years? Is it truly tough for another company to come in and copy what they are achieving related to brand and size? And when it comes to companies like Meta, they are checking those all off. The stock has had a pullback over the last month, down 10.73%, in spite of strong earnings due to some concerns about the level of AI spending that is going on. But on the day, up 1.81%, current stock price $638.69. And taking a look at 2 analyst ratings from just this week, DBS is giving it a price target of 955, and Phillips Securities is giving it a price target of 770. And the overall analyst ratings are $866 on average and 1,117 on the high. Now on to sleep well at night status. Is the company financially strong with low drama? And for this category, we're going to use Microsoft as our example. Taking a look at PE ratio, which is the price to earnings, how much you pay for $1 of profit. Debt to equity, how much the company owes versus what it currently owns. Free cash flow, how much cash they have left after paying their bills, real money that they can put back into the company, as well as pay out to the shareholders through dividends, as well as revenue growth, the percentage increase of sales year over year. So when it comes to Microsoft, year to date, they're up 20.7%. 30% of their revenue comes from Cloud Azure, and that has been growing fast by about 30% over just the last year. They have reliable cash flow from sources like Microsoft Office as well as LinkedIn. Now, let's go over the points that show if a company is financially strong. Currently, Microsoft's PE is 36, which is slightly below the industry average. This current PE suggests that investors are pricing in strong future growth, and investors are willing to pay more for the ability and the dominance in cloud and AI that Microsoft has. When it comes to Microsoft's debt to equity, or liabilities versus their assets, you can see that they are borrowing less than they own. The lower the percentage, the less debt the company uses to finance its assets, an indication of a healthy balance sheet. The cash that they have after paying their bills is also positive and growing. And when it comes to their revenue growth, their sales have been increasing, beating estimates for the last 3 quarters and projected to be at 81.2 billion by Q3 of 2026. Current share price 509.05. Looking at the analyst ratings on the MooMoo investing app, 100% rated as a buy, with an average price target of 636.78 and a high of 700. So overall, when it comes to rule number 3, think of it like this. We want to see low debt, steady income, that revenue, and extra cash on hand, proving that they are a financially sound company. Now on to rule number 4, hold for the long term. And we're going to use Amazon as our example. This company is one that we most likely know and have an Amazon Prime subscription for. The company has been thriving and continuing to improve, but they've had some rough times along the way, dropping 7 times by 30%, but just a $1,000 investment into Amazon back in 2009 would be worth about $44,000 today. So the point that I'm trying to make is you have to determine if something is worth holding. At what stage of a company's growth are you going to invest? Back in 2009, they were losing money, but trying to get started. In 2015, they launched AWS, Amazon Web Services, leading to a significant shift in their revenue. In 2020, they benefited from the COVID boom, everyone shifting to ordering online. And now in 2025, it has developed into a mature and profitable company. So when you invest into something, you have to know, are you ready to hold for the long term and wait for their story to play out? Have a mindset of, I'm going to be holding on to this investment for at least 5 years. When it comes to my portfolio, I seem to be on track to hold significantly longer when it comes to the companies that we've looked at so far. Keep on top of the quarterly earnings and have an understanding of how the current news headlines and the economy could be impacting your investments so that you can handle the daily ups and downs of the stock market. Now, for the final rule, know when to sell. Don't be emotional, be intentional. We're using Target as this example. They're actually not having a bad day, up 2.7% currently. Zooming out to the 5-year, down 42.73%. Target peaks back in 2021 with a high of about $260. And now in 2025, it's been about 135 and below, as we can see, currently under $100. What's been going on with Target? The list is long, but I'll highlight a few issues that they're having. One point is excess inventory, likely due to over-ordering, inaccurate demand forecasting, a shift in market trends, high theft, as well as low profit margins. The headlines are dismal. Why Target stock is hovering near 52-week low, even as we're approaching Black Friday. Target is acting like a company preparing for an acquisition, and Target is a dumpster fire that needs to be put out. When it comes to Target, they don't have that competitive edge. They're failing compared to Walmart and Amazon. Their earnings have been shrinking over the last 2 quarters. The debt is rising fast. And so there are definitely better opportunities elsewhere. So when it comes to a company like this, you have to evaluate your original reason for investing and decide when it's time to exit and basically fire them for being an underperformer in your portfolio. I hold all 5 of the investments that I use in today's examples, and I'm going to share the growth that I've achieved in my portfolio. So when it comes to Google, I'm currently up about 114%, Meta 18%, Microsoft 13%. Those two are smaller, newer positions to my portfolio, not dating back about 5 years like the others. Amazon, I'm currently up 67.8%, and Target, I am down 39.68%. So when it comes to Target, let me also share this. Something else you can incorporate if your investment is dropping significantly outside of factors impacting the entire stock market, like what we had with Liberation Day. You can consider putting on a stop loss so that you can more quickly catch the issue and cut it from your portfolio. One that's not a significant position when it comes to my overall growth portfolio, but definitely ready to move that money into a higher performing investment. If you haven't already, give this video a thumbs up. Make sure to subscribe to the channel. Take the time to put these rules into action the next time that you're considering incorporating a new investment, an individual stock into your portfolio. Evaluate the revenue, the PE, the company's debt, the future growth, and ask yourself, I want to own this company because. And then going forward, be ready to keep up with those earnings reports so that you can know if your original reasons for investing ever start to shift. So that's it. Make sure you invest smart in a way that does not cause you stress, because our goal here is to build wealth. Leave me some comments. Let me know what you think of these 5 rules. Are there any that you feel like you'll struggle to incorporate? Let me know your thoughts. Thanks for watching. Okay, bye.